I have here in my hands a real whole life insurance policy that has been in force for 13 years. I also have all the details regarding this policy, all of its premium payments, its cash accumulation values, as well as its outstanding death benefit. With that, I can calculate things like what's the rate of return this policy has achieved on its cash value. And with that sort of information, we can analyze a couple of other things, like how well did this policy do compared to bonds or stocks? Why is it that this specific policy did what it did over these past 13 years? And what other benefits does whole life insurance bring to the table that we might think about in coordination with this rate of return? There are a lot of people who come to us looking for information on what do whole life policies actually provide as a rate of return? And we've been able to give them an answer, but I can give you a real solid example of how a whole life policy has actually performed over a little more than the past decade. There are a couple of things to note about this policy just for people who care about the details. One, the insured in this case was relatively young when the policy was issued, in his mid-20s. In addition to that, the premium that has been paid on this policy has been mostly consistent. However, there was one variance to the premium paid in the initial year, actually, and then the premium was increased significantly. This happened more by happy accident than intentional design, but that is how it has unfolded. Just some minor details to worth noting. And with all of that said, let's jump into the things that everybody wants to know. How did this policy actually do? So as a result of having all of the policy data on this policy, including its entire premium payment history and all of the cash that has accumulated up to this point, we can plug those numbers into the software for the insurance company that issued this policy and run an actual rate of return calculation on it. This is generally referred to as the internal rate of return. So you can see that's this report that we are looking at here. Policy is currently in year 13, as I mentioned earlier, and we have cash value delineated here. We have death benefit here, but then we have the internal rate of return column, which shows us that to date, from inception to now, this policy has achieved a 4.21% rate of return on the policy's cash value. So depending on your age and experience, that number could be kind of impressive or maybe somewhat underwhelming. The expectations are going to vary, obviously, from person to person and situation to situation. But a 4.25% rate of return year over year for a whole life policy at year 13 is a pretty great result with respect to how whole life policies typically come together. Let's think through a couple of the scenarios here. One, you may own a whole life policy that is beyond 13 years and has not yet achieved that sort of rate of return. In fact, you may own a whole life policy much older than this that has never achieved that sort of rate of return and may never achieve that sort of rate of return. There are some things going on that we'll discuss in a little bit about why that is. But you may also be looking at other things regarding where you could put your money in the market these days and point out that there are things like treasuries, 10-year treasuries, that as of the recording of this video are paying something like 4.47%. So why not just buy those treasuries, since that's higher than 4.25% rate of return? Keep in mind that a 4.21% rate of return is a year-over-year rate of return you would need to have achieved on the premiums that were paid to this policy starting in year 1 and going all the way to current year 13. So each and every single year, 4.21% is what the cash value would have needed to have accumulated at to arrive at the exact same cash balance that's in the whole life policy today. Now, I do realize that 4.5% is roughly what we can get if we were to buy 10-year treasuries today. But if we go back 13 years to when this policy was issued, 4.5% as a yield on treasuries would have appeared almost unimaginable to a lot of people. In fact, the year this policy was issued, 2012, and the month this policy was issued, the current yield on 10-year treasuries in the United States was 1.98%. And going from year 1 to now, year 13, and calculating the average yield we could have achieved by buying treasuries each year on the anniversary date of this whole life policy, the average yield we would have been able to purchase on 10-year treasuries turns out to 2.39%. So when we look at this comparatively, in a fair way to when this policy was issued, what we have to keep in mind is that this policy was issued during a time frame where interest rates were significantly lower than they are today. So while you might be able to buy treasuries today that could produce maybe a better rate of return than this whole life policy has achieved up to now, you would not have been able to do that back in 2012 when this policy was issued. In fact, you would not have been able to buy treasuries at a rate above 4% prior to this year. They didn't break 4% until sometime late 2023, early 2024. So the fact that today you could buy treasuries at a rate higher than nominally higher than what this policy has achieved over the past 13 years, that is a very recent phenomenon. But let's not also forget that whole life insurance functions differently than simply buying treasuries. One, buying bonds is not an automatic reinvestment scenario. You earn income from the bonds, and you could theoretically take that income and buy more bonds, but there's no guarantee that you can buy them at the yield that you bought them at prior. Nor do you necessarily generate enough income to buy bonds in the amount that you need to buy them moving forward. So you may have a little bit of a delay while you accumulate enough income before you can actually go out and buy more bonds in order to benefit from future income from them. Life insurance doesn't have any of these issues. Additionally, the cash value inside whole life insurance grows tax deferred, which means without taxable consequence as you earn either guaranteed interest or dividends on a whole life policy. The same would not be true for treasuries unless you house them inside a retirement account. So if you were holding treasuries inside a general brokerage account and you earned income from those treasuries, you would owe ordinary income taxes on that income. Paying ordinary income taxes on the income derived from your bonds, or your treasuries in this case, is going to reduce the amount of actual rate of return you achieve. So when we're talking net, the nominal rate of return that we need to earn from something like treasuries is higher than the nominal rate that we would look at for whole life insurance in order to come out at the same point. The cash values will differ because the consequences that come along with things like treasuries are different from a taxable standpoint than they are whole life insurance. Plus, whole life insurance is easier to compound values because we can take any amount of guaranteed interest or any dividend payment and put it back into the cash value of the policy and let that compound. That is not quite as simple to do when we're buying bonds or treasuries. Now, how did this whole life policy do in comparison to stocks? Well, at 4.21%, it's not going to take a whole lot of arguing to convince people that the stock market would have done better. But we should keep in mind that stocks have a different profile, a different risk profile, a different rate of return profile. We buy stocks for different reasons than the ones that we usually use to buy whole life insurance. So our focus is different. Our tactics are different. Our strategy is different. We buy whole life insurance primarily as a safe portfolio allocation with a reasonably good rate of return. We buy stocks with a much riskier profile, but a much higher expected rate of return. The risk reward component to stocks versus whole life insurance is quite a bit higher risk for stocks with a higher reward expectation. None of that should be news to anyone. But that having been said, there are definitely years throughout these past 13 when stock market fluctuations have brought the balance of an actual investment account very close to the cash value in the whole life policy. So while ultimately, 13 years out, a stock investment is ahead of the whole life insurance, as it should be, there have been times where they've drawn pretty close to one another. And for some people, it's tough to stay the course in those moments because a beat down stock position can be quite depressing. At the same time, we should note that the policyholder here for this whole life policy never had to worry about the cash value in his whole life policy. Regardless of what the news was on the stock market or the broader economy, the one thing he always knew was that the cash value in the whole life policy was guaranteed to increase and would never decline. If at some point he decided he needed some of the money in the whole life policy, he could access it. It didn't matter what was going on with any of his other holdings inside his portfolio. So we don't have a situation where stock market goes down, you need money, you'd like to sell some of your shares to do whatever you need to do with your money, but you're in kind of an uncomfortable situation because you think your stocks are going to come back in price. You don't want to sell them when they're low. So what do? Well, you use your whole life insurance if you have it, because that's one of the key reasons people buy whole life insurance is the diversification of risk and diversification of return scenarios. So they can go to whole life insurance when stocks are bad, but stick with stocks when stocks are good. So as we've always argued, the us versus them debate is nonsense. They both have their place. We expect stocks to do better, but whole life insurance, it ain't bad. I do want to note, I mentioned earlier that some people may own whole life insurance policies that have not achieved a 4% plus rate of return and may never achieve a 4+% rate of return, and why that is. And the simple answer is it's a design thing. So whole life insurance policies have a number of different components, buttons and switches, if you will, that any agent can manipulate in a certain pattern to get a certain tactical objective achieved. If you don't know this, then a lot of people typically end up with just plain whole life insurance as their attempt, feeble at that, to grow cash in the whole life policy as a low risk component of their portfolio. It works, but it's pretty much a terribly inefficient way to approach this concept. Instead, we want to use policies that are intentionally designed for the sake of accumulating cash value. This is not as widely an understood component of life insurance among a number of licensed agents, which is unfortunate, but it is what it is. When we employ the various things we have at our disposal to create policies that have a specific intention to build cash value, we unlock a certain amount of cash building potential that far exceeds regular whole life insurance. I want to give you a for instance by taking a whole life policy issued by the exact same company that issued this policy here and compare how a non-tweaked policy, if you will, performs over the same 13-year style period. So here we have, as close as we can get it, a policy that is issued from the same insurance company designed to mimic our current real policy and see how a regular, massaged for cash value policy compares. Just a regular, plain whole life policy purchased by saying, hey, if I give you a certain amount of premium every year, just let the death benefit be whatever it's going to be. How does that accumulate cash value-wise to make a comparison? There are a couple things that we couldn't quite match up perfectly. One, the fact that the real policy did have a lower premium in year one, but does not have a lower premium in the case of year one in this scenario is just a function of the kind of reality of whole life insurance and how things work with it. So there's certain things that don't match up perfectly, but this is close enough to make a point that I think people are going to get quite easily. The other thing to note is that this policy is not the same whole life policy that really existed 13 years ago. That policy has been replaced by subsequent iterations of policies from this insurance company. So not a perfect match, but good enough for now. If we go out to year 13, what we see is that the rate of return achieved is barely over 1%. And this result here is probably what a number of people who have looked at basic whole life policies are pretty used to seeing. A number of you may be thinking that this other policy here that has been used as comparison with a 1% rate of return after 13 years is much more what you're accustomed to seeing discussed on the internet or among financial media types. And perhaps you're even sort of thinking, well, maybe that's the more realistic scenario of whole life insurance. Not necessarily. This is just what regular whole life insurance does. If you know how to unlock certain features of whole life insurance, you'll get the 4%-ish rate of return numbers that we see in this policy. But if you don't necessarily know what you're doing and you purchase regular plain whole life insurance, this result from this hypothetical scenario is much more the likely case. For what it's worth, it takes 29 years for this other just plain whole life policy to get above 4% in terms of rate of return, and nearly 35 years for it to match the result we've gotten in 13 years with this policy here. So understanding the design components that maximize cash buildup in a whole life policy is extraordinarily important. And if you're looking to use whole life insurance for this purpose, you absolutely want to talk to somebody who knows how to do these things for you. Because as you can see, making these design tweaks to a whole life policy not only benefits the policy in the short term, but there are extremely important long-term consequences to it as well. I do want to note, because it's a pretty significant realization to have, that when I say design a whole life policy better for cash accumulation, I'm not talking about some sort of negotiation for better terms. I think a lot of people look at this discussion regarding whole life insurance and they walk away thinking that it's kind of like going to the car dealership when they tell you the car is going to be $55,000 and you say, I don't want to pay $55,000. I want to pay $50,000. And after an hour's worth of back and forth, they finally go, well, how about $53,000? And you go, okay, fine. At least I got some money out of you. That's not what's going on. When we redesign a whole life policy, we're absolutely deleting features of the whole life policy that we have deemed unimportant for the purpose of your goals. By virtue of deleting those features, we are allowing more money to build up in the policy because you are not yoked by those expenses of those additional features that are simply not significant to your needs. That's a subtle but very important component to understand when it comes to whole life insurance. To gain more cash value buildup, you are giving up something else along the way. And namely, you're giving up guaranteed features, especially related to the death benefit. But you can pick up substantial death benefit by approaching whole life insurance this way. So it's not as though you are forsaking everything. You're just getting rid of some of the guaranteed aspects of it. Which is to say, if guaranteed death benefit is a paramount consideration, you don't want to approach whole life insurance this way. So 13 years later, the policy has achieved a 4.21% rate of return, which really isn't all that bad, relatively speaking, to other fixed interest rate styles of savings. It far exceeds things that could have been purchased back in 2012, like bonds, like treasuries, like CDs, and even compares favorably to them today. But as interest rates remain higher, we can expect that the dividend payable on this policy will go up, which will increase the rate of return the policy actually achieves. Plus, 4.21% is the rate of return that the policy has earned up to this point, but that rate of return will continue to improve even if the dividend stays exactly the same moving forward. In fact, by this time next year, the policy will have achieved a 4.32% rate of return year over year for 14 years. That improvement of rate of return will continue to happen for quite some time, and we expect the rate of return, if the dividend doesn't go up at all, to exceed 5% by the time this individual is in his 50s. And if the dividend scale goes up from here, well, that accelerates the point at which we expect 5% to be a reality. But there are other things that go on with whole life insurance that are absolutely noteworthy in this situation. Because not only is the rate of return very reasonable when it comes to similarly risk-profiled options for saving for retirement, but there is a host of additional tangential benefits that do, in fact, increase the features of owning this sort of policy when factoring in rate of return. Now, they're less easily quantifiable, and I haven't spent any time trying to incorporate them into this discussion. So do understand this. These numbers are all net numbers. We've assumed that the entire premium paid is the entire premium paid up against the cash value that is accumulated. We've not made any sort of deductions from that premium to account for the fact that there's a death benefit or any other feature offered by the whole life contract. And those features are quite plentiful. We have an array of tax benefits like tax-deferred accumulation of cash values, which avoids having to take some money aside and pay for taxes as they come due because of growth in the policy. We have an incredible amount of liquidity that is provided by the life insurance contract. This could be the insured on this policy has the option to, at any time and for any reason, request either a withdrawal or a loan against the policy. It doesn't matter what's going on in the market. If things are good or things are bad, he has access to the cash that's inside the policy. He also has the ability to continue to earn money on the cash value in the policy, even though he's taken a loan against the policy. Cash that acts as collateral for a loan will continue to earn guaranteed interest, and it will continue to earn dividends. So he has the option to spend the money and also earn on the money at the same time. It's a pretty remarkable feature of whole life insurance, actually. There's a lot more flexibility over the contribution that can be made to this whole life policy with respect to options that have all the benefits, especially tax benefits that this provides. So when this policy was issued, the maximum contribution to an IRA was $5,000. Today, it's $6,000 roughly, which is far below the $9,500 that's going into the policy each and every single year. So in order to accomplish these same results in a tax-favorable wrapper, if you will, the options become a lot more limited because they tend to exist for retirement style accounts, which come with certain restrictions on when you can access the money, age 59 and a half, basically. None of that is true for life insurance contracts. And we certainly have many people, clients of ours, that have put money well in excess of IRA contribution limits, well in excess of 401k contribution limits into whole life insurance contracts each and every single year because they have the extra money and they want something that comes along with those benefits, but they can't use those other vehicles because they don't allow the funding capacity that they have available to them. And let's not forget the fact that this policy also has a death benefit. And for some people, that's not all that significant, but for a large number of other people, it has at least some degree of value. So even if we go back to the Treasury example, comparing the fact that we can get 4.5% today on 10-year treasuries versus 4.21% being achieved on the whole life policy, if we think about the fact that there's a just about $1 million outstanding death benefit on this policy, that starts to change the math around a little bit when it comes to buy treasuries or use whole life insurance. In fact, there's something I want to look at real quickly about this whole life policy regarding the death benefit that speaks to a very age-old criticism some people levy towards whole life insurance. There are those who will tell you that whole life insurance does accumulate cash, and that seems pretty great. But did you know, when you die, the insurance company keeps your cash and pays your beneficiary the death benefit? This statement is technically true, but practically insignificant for a large number of people. Let me show you what I mean. So looking back at the real policy that's been in existence for 13 years here, couple things to look at. So the death benefit on the policy at inception was almost $400,000, $392,055. That's what it started out as. Today, the death benefit amount is $986,897. We'll round up, call it $987 for kind of quickly discussing this whole subject. So if we take this initial death benefit amount and we subtract it from the current outstanding death benefit amount, what we get is $594,842. So that is the difference between the death benefit that exists today and the death benefit that existed back when the policy was put in issue. I want to call your attention to the fact that $595,000 basically is a lot more money than the $160-ish thousand of cash value that's currently in the policy. So let's think about this. The policy starts out with about $400,000 in death benefit. Today, it has almost $1 million of death benefit, which means the death benefit has grown considerably by almost $600,000. It's got $160,000 in cash. And yes, technically speaking, the insurance company would keep that cash value in the event of death. But the beneficiary is going to receive almost $600,000 more than would have been paid out if death occurred at issue. I don't know about you, but I would much rather have that extra $600,000 than $160,000 on top of my original death benefit. So again, the statement that they keep your cash value and pay the death benefit is technically true, but practically insignificant. This statement really underscores a lot of people's misunderstandings when it comes to whole life insurance. And at best, it's a tool used by some people who have something else to sell you that's not whole life insurance. And at worst, an argument made by people who have no other objective than to boost their ego and win an argument. Thanks for hanging out today. If you liked this video, you'll like this one even more.